Well, good evening, everyone. This is David True. Those of you who know me or have been to our events before will know me as being part of NIPE for a while. I'm part of the leadership of NIPE. We put on these events, try to do it about once a month on all a variety of topics that are germane to payments and financial technology. And I'm very happy that you're joining us tonight for this great event on a topic of great interest to me about attending to the underserved and how can financial service providers do that in a way that benefits both the underserved and is beneficial to themselves as well. So just like to say welcome to you all as I just have, and hey, Kristen, seeing a lot of nice faces that I know here. I'd like to thank our annual sponsor, Davis Wright Tremaine, who makes it possible for NIPE to do what we do. And I'd also like to mention a little housekeeping. There'll be about a 45 to 50-minute panel discussion. During that time, please feel free to note any questions and put them in the Q&A. We'll address those questions throughout the conversation, and then afterwards, we'll have a time to address any questions that haven't been addressed during the panel discussion. And then afterwards, there will be two networking sessions of 10 to 15 minutes where you'll get a chance to talk in a small group with folks who've been involved in the conversation or been on the panel or been in the audience throughout. Another piece of housekeeping, I'd like to ask you, as we start this event during the panel discussion, to please turn off your microphones and cameras so the full attention can be given to those who are presenting the content. And with that, I'd like to introduce Michael Flores, who has organized this event and will be moderating it this evening. Hit it, Michael.
David, thank you and welcome everyone. Appreciate you taking time out on the end of a long holiday weekend. And depending where you are, it's either beautiful or very, very hot. So hopefully you had a great weekend. It's an interesting subject we're going to be talking about this evening. According to a 2020 report by the Federal Reserve, about 18% of American adults are either underbanked or unbanked. About 5% of Americans, or around 16 million, are unbanked. About 13%, or 43 million, are underbanked. Now, what's the difference? Basically, an underbanked means they have a basic transaction account that's available to them, but they still utilize alternative financial services, be it check cashing, payday lending, pawn, whatever it may be. The underbanked do not have access to basic checking services. This has been a problem that we've been looking at for years and years. It's seemingly intractable. It's been researched for a number of years. As a matter of fact, I've written and co-written several white papers and testified before 3 House and 2 Senate subcommittees on areas around the underbanked and products that are targeted toward the underbanked and the unbanked. We'll be talking about this evening various programs from legacy, alternative financial services organizations, as well as others, such as the Postal Service, which we'll touch on in their initiative over the last year or so, the subject. The results are obviously mixed. Widespread adoption remains elusive, with costs and accessibility being the major obstacles. So what are we going to discuss with our panelists this evening? One is going to be, how do we design product that meets the needs of this market and be both affordable to the consumer as well as profitable to the provider of the product or service? Talk about what works and what doesn't work, some success stories out there and some things to look out for to avoid in terms of what's been learned with some of these pilot programs. And a key issue is going to be, how do you attract customers to this? I mean, there's a whole variety of issues revolved around trust of legacy financial institutions, and we'll touch upon that a little bit. So now allow me to introduce our panels. We have a great group, and we're number one will be the Honorable Rodney Hood, who's the former chairman and current board member of NCUA, Regulators for the Credit Unions. Mr. Tal Clark, who's CEO of Instant Financial, a company providing access to earned wages. And Mr. Brenton Peck, Director of Financial Services Solutions for the Financial Health Network. Gentlemen, welcome. We look forward to a great conversation. let's have each of you give us a brief background on this and an overview of your perspectives of this issue. And we'll start out with Rodney, and then we'll go to Tal, and then end up with Brenton, and then we'll get into a give and take discussion. So Rodney, if you take it away.
Great. Well, thank you, Michael, and thank you, NIPE, for putting together this wonderful event this evening. And happy Juneteenth, everyone. I think you've all experienced a lot of different celebrations and activities there in your local communities. I know I've enjoyed the Juneteenth activities there in my DC area. You all, I am very honored to be with you because I want you to know that as the former chairman and now board member of the National Credit Union Administration, I am committed to making sure that our regulated entities have the tools and resources they need to address some of the intractable issues that Michael just enunciated when he talked about the number of unbanked and underbanked households. Credit unions today serve 131 million households. That's roughly a third of the American public with a credit union relationship. Assets approximate 2.12 trillion in assets, and they're spread out among 5,000 institutions. So I've given you the number of folks engaged, but what I haven't said is that credit unions grew following the Great Depression. They grew when many hardworking men and women from the plants and automobile factories could not obtain traditional bank financing. So what did they do? They reached into their pockets, they galvanized and marshaled their resources to create today's system of cooperative credit. Credit unions grew out of adversity, so they've long had a penchant for serving low to moderate income communities or people of modest means. The work that I'm doing now as the regulator is ensuring that they continue to stay focused on that mission, meaning that we want to help them have the loan products that they can help provide small dollar loans, doing it at affordable rates, also paving a way for these institutions to use financial coaching and counseling and capability activities, all the things it takes, ladies and gentlemen, for individuals to be fully a part of the financial mainstream. Some of the things that I'm working on, and we'll get into this a little later, I believe that fintech is integral to the ongoing success of our system. So fintech can really help our institutions of all asset sizes reach those underserved communities, providing them with real-time solutions if they need to get loan products, savings products, and whatever the case may be, helping those smaller institutions scale and really be able to provide 21st century solutions to today's communities. With that being said, I'm looking forward to today's dialogue, but the one thing I'll leave you with is I'm excited about working with you all in partnership to see how do we help our credit union system continue to grow, evolve, and again, providing the necessary tools to maybe address some of those unbanked and underbanked households in our midst. Thank you.
Great. Thanks so much, Rodney. Tal?
Yeah, thanks, Michael, and thanks to NIPE for pulling us together. It's great to have the opportunity to talk to everyone tonight. I have been involved with businesses serving the underserved for the last 20 years. I was part of a group that started one of the early prepaid programs in the US called Money Network that ultimately sold to First Data, now Fiserv. Spent some time there working on a number of different projects and leadership roles associated with payments. And then today I'm on the board and recently took the role of CEO for Instant Financial over the last year. And Instant has been leading the way in providing responsible earned wage access. And by that, we mean providing access to funds that people need to meet basic needs like gas, food, medical expenses with funds that they've earned, but typically have not received except for those 2-week pay cycles, you know, sort of forcing them into environments that aren't healthy for them from a financial perspective. So our goal is to increase access, provide that access in ways that are comfortable for employees and consumers, in ways that are not punitive to them, in ways where they don't pay fees to access those funds that they've earned on a daily basis, but still have that access. And I look forward to covering everything in more detail and talking to you guys tonight.
Great, Tal. Thanks so much. Brenton?
Well, hello, everyone, and thanks to the NIPE team for inviting me to be part of this discussion. My name is Brenton Peck. I'm a director of financial services solutions at the Financial Health Network. We are a national nonprofit organization that's based in Chicago. We've also got an office in New York City and Washington, D.C. Our origin is in direct line with this topic. For years, our organization was known as the Center for Financial Services Innovation, or CFSI, with a particular focus on bringing the needs of and underbanked consumers to light. We were actually the first group to size this marketplace, and we work with providers to develop strategies that are both good for consumers and good for business. Today, our mission is to improve financial health for all. And we do this by working with businesses, policymakers, and innovators who are all committed to our mission and committed to improving the financial health of the people that they touch. Tactically, Financial Health Network provides research, consulting, measurement tools, and opportunities for cross-sector collaboration in an effort to make this so, of which includes our upcoming Emerge conference this September 21 through 23 in Los Angeles. I get to work primarily with our high impact clients, banks, credit unions, processors, and card networks, a host of different fintechs, both large and small, and different system partners across this ecosystem. Over the past 5 years or so, different stakeholders have understood that competing on financial health is a winning strategy, and that products can be both affordable for consumers and profitable for businesses. I'm looking forward to this dialogue tonight.
Terrific, Brenton. Thanks so much. An easy question to start off with. What works and what doesn't work? And we'll go with that. Brenton, why don't you lead us off with that?
Yeah, why don't we just put this out on the table? There is no silver bullet solution when it comes to improving people's financial health. But there are things that providers, both traditional and non-traditional, can introduce to provide a more comprehensive, holistic look at somebody's financial health. Pulling these things all together is what we consider being in the business of outcomes. Right? I think for years, the market itself has said, if we just become more inclusive or we offer people a lower cost product, they'll be fine. Like that's all that people need. It's crucial to money management and money movement. But over time, we all realize that just having access to better products doesn't mean to better outcomes all the time. So that's why our organization and others have shifted focus from aligning business outcomes to consumer outcomes in the context of financial health, well-being, or wellness.
And I would agree with that wholeheartedly. I
Robin?
certainly believe that the financial inclusion piece, yes, the industry that I regulate, they've done yeoman's work when it comes to helping provide small dollar loans, financial literacy, but it goes beyond that. One just doesn't get their first small dollar loan and then become financially included. So I think it's going to take ongoing education. In fact, one of the things that we're looking at doing is I have a team of economists that work with us at the agency. And when it comes to looking at this question is, are we hiring behavioral economists to help us with designing our programs? I know a number of businesses are looking at behavioral economics, not just teaching that person how to read the credit score, but what goes into that psyche, what goes into the person who may be a compulsive buyer or the other person who doesn't really know about savings. So I think really using a lot of more thought leadership when it comes to product design, I think can go a long way. So I know we're looking to hire behavioral economists, and some of the things that have been working, I love the financial coaching model. I love the fact that there was a young lady that I recently met in Baltimore who had never had a traditional loan. She'd only used pernicious predatory payday lenders until she went to a local credit union there in Baltimore. They gave her a loan, and she's now been able to grow in terms of the financial coach that's been assigned to her, where she's now on a pathway to home ownership, something that no one would have thought would have been possible had it not been for the coaching component. So I just put in a plug for what the Financial Health Network is doing, because I know these types of things align with what have been best practices.
Tal, you're actually putting a product out there in the marketplace. Tell us about what obstacles you have faced in doing this.
Yeah, that's a great question. And you asked, I think, what works. I'll go back a little bit in history, in that, we put prepaid cards in the marketplace about 20 years ago, and there was a lot of skepticism around those solutions at the time, but they ultimately ended up being a better solution for many consumers. and are being used today on a widespread basis, and they're being used often in situations and at price points that are more competitive or better than your traditional bank environment, right? So, and I say that to move forward with what we're doing today is Instant is putting earned wage access out there, the opportunity for employees to receive their wages today. And it's new, right? And there are concerns about the space. There are, other solutions out there where you pay significant amounts of your potential paycheck to gain access to earned wages. We think there's a responsible way to do it. And we think the market will ultimately indicate that the responsible way to do this is to do it without charging punitive fees to employees. And if that is the case, and we move forward with this solution, you'll continue to see major employers in the U.S. sign up to provide these benefits to their employees so that you have access to wages that you've earned, instead of, again, we don't realize in many cases that people aren't, or we do realize, but it's not being addressed in the marketplace, that people are not making it paycheck to paycheck. We know that in the U.S. And so we need that bridge opportunity, and that bridge opportunity needs to be something that's an access point at a cost that's not punitive to the employees.
Tal, do you find companies that offer either your service or something similar, it puts them at a competitive advantage by offering this access to wages?
Yeah, absolutely. In today's environment, look, the labor market is tight as we've ever seen it, right? We know that. And we absolutely see employers and demand for earned wage access growing. We just completed a study that we had a baseline study in 2018 that asked the questions of, if your employer or an employer offered access to your wages today, would you more likely go to work for that employer? And that ran about 36% in 2018. You move forward to 2022, you ask the same question. Almost 70% of employees say they're more likely to go work in a business today if they have access to the wages daily. So we absolutely seen it growing, and we see a competitive advantage there for those employers who take advantage of it.
In today's environment, you had mentioned the cost associated with traditional checking, and prepaid cards in many cases are more reasonable. Some of the studies I did for the Prepaid Card Association years ago showed that they can be more cost effective, particularly if you throw in overdraft fees. Now that you see banks pulling away from that overdraft model, is that enticing consumers who can qualify for a checking account anymore?
I think so, but look, I think there's still gaps, right? We have a number of neobanks out there that we're all familiar with that have been successful because they're more agile. They develop features and functionality associated with card programs that they get to consumers quicker. And that's what consumers want, right? Most of the consumers entering the workplace today are millennials and Gen Z. They expect a fully featured program, and they expect it at a price point that's much below anything that we may have expected in the past. NSF fees, you know what? I think in many cases, financial institutions are recognizing that they have to eliminate NSF fees, right? It's been done in the prepaid card space for most of the providers today don't charge NSF fees and haven't for the last 10 years, right? And so banks just need to move there and are moving there. I think you'll still have a group of consumers that are more comfortable going somewhere else in the traditional bank environment, though, as we move forward.
So can I want to jump in here just for a moment, because I think, and we'll try and tie a couple of threads together. I think all of this, us on this call can intuitively appreciate that the healthier your employee base, your customer base, your membership, the healthier that they are, the healthier your business should be. And it doesn't matter if it's an earned wage access provider, a prepaid card, or a no overdraft type of account, right? But what I think most traditional financial institutions need to do is shift their thinking and align how they look at business success with customer success. And for a lot of us, that might be uncomfortable. It might be taking what we know to be a short-term transactional-based playbook and putting forward a longer-term relationship-based approach. Because the healthier that people are, the more stuff that they buy, the longer they stay with you, the more satisfied they are with as a traditional financial institution. But take your favorite neobank as an example, right? The evolution of prepaid cards. They offer high quality deposit accounts without the fear of overdraft. But they're also chock full of features and rewards, which of course is so much easier to do if you're a digital only provider. And the market may look at it as a race to the bottom. But really what these examples are doing, in my opinion, is they're expanding their product portfolio in a way that's capturing more of consumers' wallet by hitting on things that are still neglected largely in the financial services space. They offer high yield savings pockets, credit building tools that all address people's financial health needs, right? And if you're a traditional bank or credit union, you can't follow this playbook verbatim. But what I think you can do is become a financial health provider that helps people along this journey with the products and services you might offer today, or identify the ones that you need to offer tomorrow.
Brenton, I couldn't agree with you more. And you're right. I don't expect the 5,000 institutions we currently oversee to follow the neobank model verbatim. But what I do want to accomplish as the regulator and also the insurer of their accounts is, am I giving them that regulatory flexibility to partner with them, to use ventures and things of that nature to maybe add onto their platform? To your point, I've seen some of our credit unions that are partnering with fintechs, and they're doing a masterful job. That's how they're able to get members with lower interest rates on their mortgages, lower interest rates on their car loans. But in addition to that, a lot of the fintech providers are giving, to your point about the millennials and the new workforce, they're giving them the tools that they want. Many of them have grown up in a digital native environment. So we need to really make sure that our legacy credit unions and to some degree banks, that they are keeping up with the speed of technology. So while again, we don't expect them to follow verbatim, if I am really being that forward-thinking regulator, I think creating opportunities for them to work in partnership, I think is going to help really close a lot of that gap. And I really am proud of the fact that we have a number of credit unions that are already working with fintechs. In fact, we're going to be doing a big conference on bankable finance through fintech on June 28th. So I would encourage those of you who are interested in this subject to really look into joining us. But again, I want to pave that way for them to know that this regulator is not going to impede progress, and I'm not expecting them to do it in a silo, but with partners.
One of the things I want
on this call.
One of the things I want to touch on before we get to actually how you design products that are affordable and profitable to the provider is the economic situation we're finding ourselves in right now. We haven't seen inflation like this, 40 years almost. And actually, some of the projections of conventional wisdom are we're looking through 2022, the rest of this year in inflationary mode. What does this do to this marketplace of the unbanked and the underbanked? Their dollars are shrinking. Their purchasing power is shrinking. How can they afford to acquire new products? It puts them in a greater squeeze than they're already in.
Yeah, I think that, look, you're hitting a sort of a salient point for where we are right now. But what I'll tell you is what we see the spend at gas, groceries, and healthcare, right? We know two of those three things have gone up dramatically, right? Gas and groceries. It's harder to get a read on healthcare necessarily, but we would assume that is as well. So it just points to the opportunity, I think, and the need for alternative means of access to cash, probably quicker. That paycheck by definition is going to last for a shorter period of time than it has. We already can't make it to the next payday. That becomes even more difficult now. And the way we have to deliver those services in a way, again, that's not punitive to the consumer. And, it's at least in the businesses that I've been involved with, mostly it's been through the employers, right? Most of the opportunity to help employees and help consumers is through employers, right? That's where these services can be delivered in a way that makes sense for the business and makes sense for the employee and the consumer as well.
We haven't really seen, I've seen some examples of companies raising wages across the board to help out their employees. But if we get into that 1970s style wage price spiral that is a horrible position to be in, stagflation. What does that do to the provider's ability to implement products that are affordable to this marketplace when their costs are going up?
Yeah, look, I think that our revenue model is primarily based on interchange, right? I mean, as most of the banks are, that's the way we operate. That's the way credit unions operate with their cards. So that doesn't mean interchange isn't going to change this year. It might change next year. It depends on what MasterCard and Visa and others decide they want to do with the interchange tables. But I think for the most part, we try to find ways to hold our cost structure the way it is and continue to provide the services that we provide. I don't think that you would see providers raise fees as an example in some way to offset the changes in the economy. So look, it becomes a pain point a little bit for everybody, but I believe we can continue to deliver the services we're doing it at the price point we're delivering it without changes in this market.
And Tal, I would even add on to that. Yes, we are seeing some pressures now with earnings and whatnot, given the economy, but our credit unions, I failed to mention, these are tax exempt, not-for-profit cooperatives. So their funding model is a bit different. And yes, we want them to be sustainable and vibrant, but not to the degree that they have for-profit concerns the way of a lot of banks would probably have to worry about. So it's because of that I think credit unions are uniquely positioned to continue providing, I would like to think, a high quality of service and still making their products affordable. Again, having grown out of the Depression, they know what it's like to work in a difficult operating environment. But again, they're able to really continue focusing on relationship building as opposed to transaction. So I think that will carry them through. And something that I can say as a regulator, and I see this from all of the financial services, you all coming into this, the banks and credit unions are flush now with liquidity and strong capital. Our capital is probably stronger than it's been in probably 2 decades, and also some very ample liquidity. So the tools are there, at least from where I'm sitting, for credit unions to be very responsive without any uptick in having to raise fees or anything like that that would really exacerbate some of the problems that these member owners are facing today.
Yeah, let me try and maybe walk us up a level here, because I think oftentimes banks and credit unions and direct-to-consumer providers jump to product. I also don't think that's always right. So when we've taken an outcomes-based approach for consumers, we call it financial health. Others might call it financial wellness, financial well-being. It's all the same stuff. We define that term when somebody's day-to-day financial system functions well, so they can be resilient when facing one of those inevitable and pesky financial shocks, and then pursue their longer-term opportunities, dreams, goals, aspirations, however you want to define those. But using that definition and with working within industries, we created a framework that makes financial health measurement and strategy execution actually possible. And when I think about that, it really boils down to how people are spending money, saving money, borrowing, and planning in ways that set them up for success in the future. So take underbanked out of the equation for a moment, take product out of the equation for a moment. The number of people in this country who are struggling financially is significant. And so we size that market at about 166 million Americans, about 2/3 of the population, who are struggling with aspects of their financial health. So my advice is don't assume that what looks good on paper is right for customers in this moment, even if it hits on some of those macroeconomic factors at play. You know, I have spirited conversations with providers all the time who say, what can I be doing to help solve the savings crisis of today, the emergency savings crisis? I don't know if that's right. I honestly don't know if promoting short-term savings is right because of the cost of everyday goods. And we're seeing it in our data and other people's data at this moment, is that people are living closer to the edge than they ever have before. And it's not based on income quartile or quintile, no longer, right? A study just came out by Nielsen that estimated about 1/3 of the population who are making more than $150,000 a year are living paycheck to paycheck. So if it's not just about income, then what is it? And we believe it's about behaviors and attitudes toward money. And we wrap that into the framework that I just described.
What do you look at the timeline And this sounds like an evolutionary approach. Isn't something you take a 3-day seminar and all of a sudden you change your behaviors.
That's right. We measure on an annual basis. I think it would be foolish of any provider to think if you introduce a product or a service delivery or hell, a Marcom campaign, that you're going to change people's view or behavior anytime sooner. There are some that you might be able to accelerate some of the aspects of financial health, but I'd look on an annual basis.
Rodney, what are you seeing out in the credit unions area in terms of acquisition of new customers that may not have historically been involved with a legacy financial institution?
Really good question, Michael. I'm really surprised when I gave that number of about 131 million credit union members or customers. 7 million of those folks came over the past few years at the start of the pandemic, recognizing that their credit unions were their local, that they really were looking for providers that could give them a lot of help during the time of crisis. Credit unions did a lot of PPP loans. They were able to do a lot of small dollar lending. And I think the acquisition of customers has come through, one, word of mouth. Also, I think when you look at some of the trust scores that we see with Gallup and others, the credit unions tend to score really favorably well. So I think that's helped them really attract a lot of new members. In addition to that, I just think that the model is one that, again, is built on the spirit of cooperation. I mentioned fintechs. Those credit unions that are working with fintech providers have been able to use that as a tool to get especially some of that younger demographic. So I'm pleased that we are seeing the growth, but I'm going to measure growth not just by the number, but how in terms of we really providing tools and products. So just getting these individuals on the door is fine, but are we providing them with the solutions and the affordability that they need to be long-term credit union members?
Got a couple questions that are salient to what we're talking about right now before we get to our regular Q&A section. But basically, it's who is positioned, what firms are best positioned to serve this market. And we're talking about companies such as Walmart. And I think the consensus may be they will be a bank at some point in time. They'll get a charter at some point in time. And it's an interesting question where it says they don't need to make much margin from financial services product, which basically saying it's being subsidized. I mean, every analysis I've done in banks for the last 30 years has shown that 20% of the account base basically subsidizes the rest of the account base. And so if it's not for specific subsidies, do you see these companies like Walmart being able to make a difference?
Yeah, I mean, I think so. Look, it's from a fintech perspective, it's tough to get down to small businesses. 60% of the labor force in the U.S. today is employed by small businesses. Most businesses like ours generally start at the enterprise level, 1,000 employees or above. I think there's a significant opportunity for Walmart to continue to expand services. They pretty much provide everything you need today. They just completed an acquisition a few months ago of a neobank and actually an earned wage provider. Was a $400 million transaction done by Walmart Ventures Group, sort of separate from their retail group. So they clearly have interest in providing additional services. And they are in most even small towns today. You can have Walmart access, but I think, the credit unions are a good place to start in small towns as well, small businesses. And those are the services, I think, where you still see those payday lenders thriving in small towns or towns where, services from fintechs and other large employers are not available. You see payday lenders thriving. And I think Walmart can help with that. I think credit unions can help with that. And many of your local banks can help with that if they had the right services that sort of advance to those consumer needs.
Let's talk about postal banking in terms of an initiative that has been out there. And without poisoning the well, give us your thoughts on what worked, what didn't work, the issues around postal banking. Rodney, you're a regulator. You're in DC with all this.
I'm still trying to get my arms around the research. I know that there are some countries that have really done a yeoman's job or a good job with postal banking. I'm not really convinced that here in the United States, yes, they have locations throughout the country, and they're in rural communities, but I still don't know if our postal banking system is structured in a manner that can really help them do the banking services. I mean, many of us on the call today, we've all been bankers or analysts, and we've worked in regulated entities. I've spent nearly 30 years around credit and finance, and I just don't know if that is a skill set that we are equipping our postal workers with when they are signing up for the job. And what concerns me is that there are those that are thinking that banking can just be distilled from, okay, you're going to show up one day and dispense loans and applications, and there's more to it than that. I mean, there's so many other things that even our entry level folks work at in the teller line around Bank Secrecy Act and onboarding and KYC, and there are a whole number of things. So yes, it's desirable that I'm sure in many circles to have postal banking, but let's not lose sight of the fact that there are a lot of training efforts and other things that go into making banking possible and successful. And especially you all, when we're talking about helping underserved, vulnerable, marginalized communities, these are folks that are going to really need even more attention when it comes to that onboarding process. And I just would say, I'm not going to say no, but I would say I need to get more information in terms of how are we going to go from training those individuals from what they've done day to day to really being a part of the banking system.
It seems postal banking bet on the physical locations that they're everywhere in the country. And with technology and the fact that even the underbanked market, everybody has a smartphone now, by and large. Is that really a false premise saying because we have physical locations, the customers will come to us?
Well, I mean, again, you're catching my visceral reaction here, but we have thousands of gas stations as well. So does that mean that that's the next vehicle? So again, I just think that the training and everything that goes into either you're working at a bank or a credit union, just to say that that skill is transferable on day one to the postal community, it's not one that I am convinced now. But again, I tend to approach things with an open mind. So show me the data and show me how there's going to be a work plan. But again, I think that many of the individuals that are coming into the system new, it's going to be more high touch than someone who is digitally native and savvy around some of these products. So again, I just think that that's something that I'd rather see the existing banks and credit unions work to address. I think with fintech, and as I mentioned, that's going to allow a lot more opportunities for products to be more readily available. I think the tools are there now, and I don't know about for all of you, but I think the Postal Service has a number of challenges of which it's navigating now, and I'd rather see them address those before there are other things added to their workload.
Brenton, how do you, with your research that your folks have done, how should products be designed to meet the needs of this marketplace?
Yeah, and maybe we'll try and connect a couple of dots here, but to Rodney's point and your earlier question, Michael, who is better served to serve the underserved? My opinion is that product and product design and delivery will win, not necessarily distribution channel. I think you're seeing that play out. If you look at retailers as bankers, for example, the idea of banking where you shop, it all hinges on a high quality product that meets the needs of people today, right? So when I think about what works, I think monoline products are in trouble. I think you need to take a step back and look at the holistic picture of what somebody needs. We've created the framework that we believe works because that was built with industry policy in mind. Others have something similar. Right? It's addressing 4 key areas of somebody's financial health, and you're seeing that play out in the form of neobanks, high quality credit union offerings, and even some mega banks are getting into the game. Right? Both traditional and non-traditional institutions should start somewhere around that, though. And whether you're in rural America or you're more urbanized, actually understanding what people's pain points are will lead you to the right product. To your postal question, I'll say it, I think it's asinine. I think there's a reason why it still exists on the sideline, and I don't need the Postal Service losing my money. They already lose my postal.
Understood. Tal, any questions? I mean, you're the one providing services out there.
Yeah, I think that, I mean, I think we pretty much said it all on the Postal Service. The only thing I will add is I've got two adult children, 24 and 26 years old, and I'm not sure they've ever been in the post office before. Now they also bank virtually too. I'm not sure they've been in the bank branch either, but I think the services that are offered are plentiful. There are opportunities. We mentioned earlier that millennials and Gen Z comprise most of the workforce. That's sort of that age group. They have opportunities to find financial services outside of the Postal Service. And, I would have a hard time seeing that be successful long term. And I think those resources should be diverted to making sure our mail gets there on time, I guess, at the end of the day, right?
Yeah. In terms of barriers to entry, people looking to get out, I mean, it's the addressable market is obviously very large, where there's 60 million underbanked, or to Brenton's point, 166 million financially challenged. Is there a model that without subsidies, whether it's internal subsidies within a bank or a commercial operation, somehow taking cuts on margin to provide these products, can an organization develop a profitable product that's affordable to the consumer?
You mean outside of the fintech space, or is the question within?
I'd include fintech. I mean that, yeah.
Yeah, I mean, I think that they are there, right? I mean, I think that we do have those solutions that are being delivered that are profitable. I mean, if you go back and you start with, we talked about prepaid debit cards, whether it's through employers or through the consumer directly, and then you move forward to some of the other things. There are short-term loan options and providers out there via the employers that are not punitive in nature, that have low interest loans based on salary. I think those services are being provided, and then through the earned wage access market, that you can have access to cash today without fees, or without significant fees in some competitive spaces as well. So I think those things are out there. We're talking about bringing things like a marketplace around the consumer as well, like via these programs, give you access to everything from savings accounts to insurance that you might need, whether it's healthcare, dental, whatever it may be, to the opportunity to even to pull you into an investing environment from a micro sense, right? Giving those tools. So I think ultimately you will see all those things brought to the marketplace from a fintech standpoint, in a way that is profitable, and in a way that's very consumer friendly as well.
Before we get to our Q&A and have you guys sum up for us, we talked during our prep call, a university professor who spent time at a check cashier in New York, and really turned her opinion around in terms of the value to the customer base, and a very high touch feel that the employees really cared about their customers. Brenton, you know the study. So we talk about fintech in one case, and maybe not the need for physical location, but it seems there's a segment of the market that does very well in these high touch environments. What are your thoughts?
Absolutely. I mean, I think it's about meeting customers where they are, right? And the book that you're referring to, Michael, is called Unbanked in America. I encourage everybody on this call to take a look. It's written by Lisa Servan. We do an experiential workshop where we take executives, put them through a simulation where it's like you're living paycheck to paycheck and you're underbanked or unbanked. And I recall a moment where Lisa and other executives from banks went into a payday lender, took a screenshot of the prices, the price sheet, which was upwards of 420% APR for a 2-week loan, and then took a picture of the opposite corner, which was a kid play area so that mom could conduct business with her favorite teller on the other side of the bulletproof glass. And it's meeting consumers where they are and understanding what their actual needs are in the moment that go beyond the way that traditional institutions should think about price and distribution. And I thought that was really powerful for a couple of reasons, but mainly because I have yet to find a bank, a credit union, or anybody engaged in financial services who are offering something similar.
Good. Gentlemen, this has been a great discussion. Rodney, why don't we start off with you and any closing remarks you have before we get to the Q&A?
Yes, I would just close by thanking you again, NIPE, for putting this convening together, and my fellow panelists. If there's anything I think that we all three have underscored us, I think that there is a genuine commitment around serving the needs of underserved and unbanked communities, whether it's the regulator or the fintechs or the not-for-profits that we all have here on the call today. I just think there is an interest that's there. I know with a lot of the bank regulators that I talk to, we all have different programs and groups centered on financial inclusion and access. I don't see that changing. I see that even getting even more enhanced in the days ahead. So again, for me, from where I sit as a regulator, I want to provide our entities with the flexibility, the empowerment that they need to succeed and to, again, help address the issues that we've been discussing today. I'm going to do that through creating our new Office of Innovation and Access, through my policies, and through all that it's going to take to make sure that we are bringing more individuals into the financial mainstream.
Great. Thanks so much. We really appreciate it. Brenton.
Thanks again, Michael and team, for having us. Listen, you don't know what you don't know, right? So whether it's a financial health strategy or an underserved strategy, it needs to begin with a needs assessment for both traditional and non-traditional institutions. Start measuring the financial outcomes of people that you touch. That way, you can better understand specific consumer pain points related to those indicators. We call it spend, save, borrow, plan, but that can lead to product design. But only then can you actually develop and execute a strategy that hits people where they are.
Thanks so much. Tal?
Yeah, thanks again for the opportunity to be here, and I appreciate everybody's time. I think, I guess the message that I'd like to leave is that we've solved a lot of problems over the last 20 or so years through innovation in fintech and the opportunities we've created for access to those who haven't had it before. And I think that will continue to happen. And I think, then the other thing for us, and as we talk to employers and businesses we work with out there, we often see that people really don't think about their employees or the consumers in their businesses from their shoes, right? They think about it from where they're sitting versus where their employees are sitting. And I think as we sort of consider what we're talking about here and opportunities going forward, we really need to try to consider it from those people we're trying to serve versus from where we sit. And I see that as a gap that is oftentimes hard to fill. And if we can do that, I think we'll be successful with all these programs.
Wonderful. Thank you again so much, everybody. Got a question here, leads right into for you, Tal, from Tay Revez. With access to earned income on a daily basis or so, is there a danger that the paycheck will be spent on daily running expenses and not available for large mandatory expenses such as rent, car payments, whatever?
Yeah, that's absolutely a concern. It's the reason that we only provide up to 50% of their earned wages, right? We're providing 50% of their gross earned wages. There are programs that would provide 100%, and we do think that's a bad decision because I do think we're trying to build financial management into what we're doing as well. Give you the opportunity to pull funds when you need it. So up to 50% of your earned gross wages, right? Get that tank of gas if you need it, get those groceries if you need it, but still sort of help you manage to the end. And so you have some of your paycheck left over when you receive it at the end of the two-week cycle.
Another question from Joel. They need to bring Joel online to ask us this. I'd be interested in efforts to increase the earnings of underbanked, unbanked. Obviously, more money would solve a lot of problems for everybody. Joel, if you want to expand upon that at all.
I mean, while we're waiting, look, we do see employers doing that today. We see employers having sign-on bonuses, recruiting bonuses, everything that they can possibly do to recruit and retain workers today. So we see that happening. Is it probably never going to be enough in some cases, but we do see them changing their approaches to hiring and retaining employees.
Yeah, I mean, hi, this is Joel, and I'd asked that question, and that's my it's sort of a squeeze the stone harder and try to get water out of it, or sort of expand, which is dealing with the existing incomes and perhaps spending habits of folks who don't quite have enough money, versus helping them to increase their income. Because as long as people have tight incomes, they're going to have very constrained opportunities and very constrained options. I mean, with fintech, we're able to do certain things that can mitigate issues, but at the end of the day, not enough income is not enough income. And I'm just curious about any efforts to address that side of the income statement for these folks.
Yeah, it's a great question, Joel. You can't be financially healthy without an income. I'm going to put a link in the chat here. We work with a company that's called Steady. It allows you to subsidize a more regular paycheck with other opportunities in your local area, part-time gig work. They have transparent salary information across the board, which gives the employee a little bit more negotiating power as well.
Great, thanks.
And then Joel, this isn't directly tied to your question, but I launched an initiative called Second Chance. And these are for our justice involved individuals who traditionally were never able to work for a federally insured institution, whether it be a bank or credit union. And what happened is that many of these folks that had nonviolent offenses, but yet they were barred from working in these insured entities. So we have launched an initiative to give folks opportunities to work at our credit unions and things of that nature. And again, to Brenton's point, it's hard to be financially included if you don't really have a good salary. So we had about 60 million or so justice involved individuals who have been barred, again, from certain institutions. And we have tried to remove that barrier. So I think you're finding more and more companies, whether it be, and the FDIC did a similar ruling on this. So you're going to see more folks doing things like this. I know that it's called ban the box. There are a lot of corporations that are looking at this. Again, how do you bring these justice involved folks into the financial mainstream? And you can't do it if they've been banned. So I think there are going to be more efforts like that.
I appreciate that, Rodney. The whole system can sometimes work against the interests of the least fortunate among us.
Well, exactly. Again, as I say in my speech, as I said, some of these folks have paid off their debt to society, but yet they're still like Hester Prynne from the Scarlet Letter, and let's remove that barrier or that Scarlet Letter.
Great.
Another question came up, expanding upon, I had mentioned about accounts being subsidized, the 80-20 rule. And is there any way around that? And let me, before I turn it over to the panel, it's called the Pareto Principle. And basically, it's an Italian economist years ago that determined that 20% of the land in Italy was owned, or 80% of the land in Italy was owned by 20% of the population. This stratification, I've done this for 40 years now. I count what it's been, loan portfolios, DDA portfolios, whatever it may be. And you do have, and sometimes it's less, sometimes you have 12% of the accounts representing more than 90+% of the value to the consumer. So I don't know a way around this. I mean, you can slice and dice and get a smaller sample, but you re-stratify, you're still going to come up with that 80-20. Now, I will say from a banking perspective, with automation, with the cost of, we're not processing physical checks or transporting physical checks anymore, and things of that nature, the cost of actually processing transactions with technology has gone down tremendously. So, there's a way to offer transaction accounts at a lesser cost than there was historically before we digitized all these transactions. But, I'll open it up to the panel. What are your thoughts about these cross subsidies of, the high income, high value customers actually earn. And in most cases, if they're small percent of the customers representing 100+% of the income or the profit to the organization, because the lower tier strata are costing money. They're being operated at a loss to the organization.
Yeah, I mean, I think that subsidizing costs will be the case throughout different sectors of our economy, not just banking. That's not the way that I look at the market for serving the underserved, though. There's a pretty clear business opportunity. You need to meet consumers where they are and think more holistically about the product packages and services that you're delivering. But I'm not an economist. I don't claim to be. I can't imagine you're going to generate the amount of margin for a lower income underserved consumer as you would with a higher income.
Great. Ron, do you have any other questions from the group?
I think there was just one question I actually asked, which is, if you had to point to 2 or 3 must-have products that are potentially profitable and of interest and needed by that market segment, the underserved, what are those banking products that we should be looking, pointing our finger to? Is it, I'll point out, is it various lending services, payday lending? Is it other types of products or services like remittance, money movement to family and friends in other countries? Is it a transactional account, whether it be prepaid or other? I'm just trying to think through, at the end of the day, how do you summarize where should our attention be focused? Do the panelists have any sense one way or the other, or want to speak to one or more of those?
Well, I think you put a pretty good list there, to be honest with you. I think you hit them all. Look, I think you need a transaction account. 20 years ago, many Americans did not have a transaction account. Prepaid has changed that to a certain extent. There's still, people living in the US today that don't have a transaction account. You have to have a transaction account in the US, right? You have to have one to buy gas in most cases, right? Cash is going away. Checks aren't accepted in many places. And then from a transaction account, what you need is access to cash. And that access to cash is going to be more than, we know it's going to be more than what you have between paydays, right? So you need additional cash. And we would like to think that's not going to be the sort of pernicious payday loan environment that we've seen in the past. But look, we've also said that there are organizations that serve, this population well, and they serve it with the relationships, and it's comfortable. So if they're comfortable going there, maybe they'll continue to be a fit, especially small towns and other communities where there's not other access. You would hope that there would be protections in place so that they're not punitive. But I think there's alternatives to that. I think we know today, we've talked about earned wage access. We won't go there again, but you can get that through your employer. You can also, through your employer today, get access to short-term loans above and beyond your earned wages, right? And those generally are better and are not punitive to the employee. They're competitive with what most of us could get on a short-term loan with most financial institutions. So that's out there. The remittance piece you mentioned is very significant, and there's a number of creative fintechs, a couple here in Atlanta and other places, that are doing remittances today from a transaction account, and it's multi-currency, and in many cases, the cost of that is very low. So those 3 things I think are sort of key today. What would you add to that? I think we continue to try to figure out how to add other benefits and services that these employees need around that. We call it a marketplace often, but there's still a shortage of good, affordable, emergency type health insurance. There's a shortage of, perhaps emergency type dental insurance. So I think all of those services can be brought to the consumer and continue to do it. But it all starts with a transactional account. Really, from a fintech perspective, you have to have the transactional account to make the rest of that work.
Got a question here, and forgive me if I mispronounce your name, Aradam. You want to come online and ask it?
Yeah, so hi. So my question for everybody is, or especially the panel, is do you believe that, or is it possible to use your existing relationships with your business customers to make it almost mandatory for the business customers to offer financial education in the workplace?
So I don't think we need to make it mandatory. Most of the large employers that I'm talking with today, they want to provide financial wellness, financial education to the employers. What I will be, in all candor, what we see is those that have offered it, it's very seldom used. And I've been in this space for 20 years. People have been talking about financial wellness, financial tools sold to the employer that whole time. And those that have bought it or signed up for it, you just don't see it used, right? Now, I met with a startup, new fintech, that they're doing something very interesting that I think could be interesting over the next couple of years, which is immediate feedback, right? So they see transaction history. They're not giving you financial management tools. They're not giving you financial wellness package. What they're giving you is real-time financial coaching, right? Did we see that you're spending more at this place than you had in the past. Do you really need to do that? We see that you just signed up for a high interest car loan. The amount of your car loan has gone up. So they're giving real-time feedback, and we see that getting some traction. And I think that might be more worthwhile to consumers going forward.
Is there?
I'll ask one other question, if you don't mind. In the past, I've been a judge for the RemTech Awards with the International Money Transfer Conference. And of the 32 companies that I looked at, one that was very intriguing to me was a company in Africa that developed a digital mobile wallet. And the mobile wallet had a remittance capability built into it, so that it provided, one, a transactional account. It could be used to be for payment at merchants or for other individuals, a P2P service. And it also enabled them to move funds to family and friends in other markets. And I guess I would turn to the three of you, Rodney, because of a lot of the fintech interests you have right now. Have you come across any new or unique cases where financial services are being provided to the underserved that maybe hadn't been around in the past?
Well, to your point, we are seeing some of our fintechs that are helping credit unions use the iPhones, or the Android for that matter. I don't want to be brand specific here. We're seeing that primarily on the payment side, of course. To the piece you made in Africa, I remember being in Africa over a decade ago, and I was blown away that I was in Kenya, and the phone technology that was being deployed there to help with payments and remittances was just even light years where we are here today. I think we're seeing the young millennials and the other folks that the credit union system is attracting. Again, it's those credit unions that are investing in digital platforms. Those are the ones that have proven to be most successful. And those that have not, I think they're following suit now, meaning they're like, hey, how do we leverage this?
Very interesting. I'm sorry to do this, but I think we're coming to the end of our panel time-wise, but we have another part of this coming up. First of all, I've been talking, but I didn't introduce myself. I'm Ron Mazurski. I'm the founder of NIPAY, also a board member and an officer. I want to thank Michael and our panelists, Brenton, Rodney, Tal. This has been a great session, very intriguing, and there's, I think, so many more questions out there, and maybe not a lot of answers yet, but we're all working on it. I want to thank our attendees for joining us. It's been great that we've had folks come here, especially on Juneteenth. So a lot of the banks are closed today. A lot of folks are off doing their extended weekend. So we appreciate everyone who has joined in. Attendees, for those of you that enjoyed the session. We certainly invite you to become more active with NIPE and to perhaps join the events committee. We've got lots of questions out there and lots of people with great experience to help us think it through. I want to highlight that our next event coming up will be on July 19th. And the topic is going to be core banking transformation to cloud or not to cloud. And we have a great panel coming up. Dave Foss, who is the CEO of Jack Henry, will be on the panel. Robin Smith, who's head of North American business for Mambu, which is a thin cloud core provider. And we have Ben Maxim, who is the VP of Innovation for MSU, FCU, and the CTO of Reseda Group. Next, I just wanted to let everyone know we have a session coming up for the next 20 minutes or so, a networking session. And we're going to have about 5 people randomly chosen into groups so that you'll be able to meet some of your fellow attendees and even some of our panelists will be there. So please stick around for this next session. And I believe Bill from NIPE will be moving everybody into their appropriate groups. Bill?
Okay, stand by. You're going to go into your group.